In early 2026, the IMF revised down Kenya's economic growth forecast from 4.9% to 4.5%, citing global uncertainty, higher energy costs, and renewed inflation pressures. But behind those headlines lies a deeper shift taking place inside Kenya's economy. After years of debt-funded development, tighter fiscal conditions, and growing resistance to higher taxes are forcing the government to rethink how growth is financed. Increasingly, the answer appears to be private capital, through public-private partnerships, asset monetization, and a larger role for investors. In this video, we ask whether this marks the beginning of a more sustainable growth model for Kenya, or is the government simply kicking the can down the road and hoping the reckoning never comes? Hi, welcome to The Growth Line, a show dedicated to helping you better understand African businesses, markets, and economies. As of February 2026, Kenya's public debt stood at 12.84 trillion, the highest level in the country's history. That represented an increase of roughly 1.71 trillion shillings, or 15% in just 12 months. At the same time, Kenya's debt to GDP ratio reached 69.5%, while the government allocated 1.72 trillion shillings to debt servicing in the 2024-2025 financial year. These figures raise an increasingly important question. How does a country continue funding growth and development when a growing share of public revenue is already committed elsewhere? The challenge becomes even more complicated because borrowing is only one side of the equation. Raising additional revenue has also become increasingly difficult. In both 2024 and 2025, proposed finance bill measures triggered public protests and intensified debate around the country's tax burden and cost of living. The message from Kenyans was clear. The government's room to raise taxes may be narrower than before. That leaves policymakers facing a difficult balancing act. How do you continue funding development while limiting additional borrowing and avoiding further pressure on households and businesses? You might have heard these terms appearing more often in the news recently than before. PPP, asset monetization, securitization. What are they? Put simply, they are alternative ways for governments to finance projects beyond traditional taxation. Constraints in revenue generation have led the government to explore these new funding mechanisms. A landmark example was the government's sale of 65% of its stake in Kenya Pipeline Company, marking the nation's first IPO since 2008. Remarkably, the IPO was oversubscribed, and the government was able to raise the targeted 106 billion Kenya shillings. In a slightly different deal, the government planned to sell 15% of its stake in Safaricom plc to Vodacom, aiming to raise over 200 billion Kenya shillings. However, this deal is currently on hold after a court challenge. Critics argue the shares were undervalued, public participation was insufficient, and the sale risks customer data sovereignty for Safaricom users. Both of these deals emerged after Kenya enacted the Privatization Act of 2025, which established a privatization authority under the National Treasury. This authority is tasked with overseeing the process, ensuring transparency, public participation, and parliamentary approval. The Act also names other state-owned enterprises as potential candidates for future sale. These include the New Kenya Cooperative Creameries and the Kenyatta International Conference Center. While proceeds from the sale of state assets are expected to flow into a sovereign investment fund, the government is increasingly turning to public-private partnerships to finance specific infrastructure projects. The most visible example of this approach is the Nairobi Expressway, which opened in 2022. The 27-kilometer road was developed under a PPP model by China Road and Bridge Corporation and is currently operated through its subsidiary Moja Expressway Company Limited. Under the arrangement, the private partner financed, designed, built, and now operates the road while recovering its investment through toll collections over an agreed concession period. The government now hopes to extend similar financing structures to future projects. One of the most ambitious is the proposed Rironi-Mau Summit Highway expansion, where China Road and Bridge Corporation partnered with National Social Security Fund to deliver the approximately $1.3 billion project. Construction has begun with an estimated 2-year delivery timeline, after which the road is expected to operate as a tolled corridor for 28 years to allow investors to recover their capital. Another landmark PPP project currently underway aims to strengthen Kenya's electricity transmission network. In December 2025, the Kenya Electricity Transmission Company KETRACO signed a public-private partnership with a consortium comprising Africa 50 and Power Grid Corporation of India. The 40.4 billion project involves the design, financing, construction, operation, and maintenance of 2 high-voltage transmission lines across western and northern Kenya. The investors in this project will recover their investment over an agreed concession period. The government hopes that structures like this will allow critical infrastructure projects to continue despite tighter fiscal conditions and competing budget priorities. Beyond privatization and PPPs, Kenya has also experimented with new financing structures tied to specific projects. An example is Talanta Sports City, the flagship stadium project being developed ahead of AFCON 2027. Rather than funding the project through conventional government borrowing, the country raised approximately 44.8 billion through an infrastructure asset-backed security listed on the Nairobi Securities Exchange. The 15-year bond offered investors a 15% return, which is relatively high considering that interest on the bond will be exempted from withholding tax. Supporters viewed the deal as evidence of a maturing capital market and reduced reliance on external borrowing. Critics, on the other hand, questioned whether the high long-term repayment obligations simply shifted fiscal pressure into the future. What the Kenyan government is attempting is not unique to Kenya. In 2022, Egypt found itself facing one of its most severe foreign currency and debt crises in decades. The war in Ukraine caused food import costs to rise sharply, while conflict in the region contributed to a collapse in Suez Canal revenues by more than 50%. As pressure mounted on public finances and external balances, the country turned to an IMF support program. The reforms were significant. Egypt allowed its currency, the Egyptian pound, to float more freely, resulting in a sharp devaluation. Interest rates were raised aggressively in an attempt to control inflation. Alongside these measures, the government accelerated fiscal consolidation efforts by reducing subsidies and expanding its privatization program. More than 30 state-linked companies were identified for partial or full divestiture. By mid-2025, Egypt had raised over $5.9 billion through 21 transactions, including IPOs and strategic sales. The government also shifted many state-owned assets under the Sovereign Fund of Egypt to accelerate investment and restructuring. Whether Egypt ultimately achieved its objectives remains open to interpretation. At the macroeconomic level, the reforms contributed to lower inflation, improved investor confidence, stronger foreign currency reserves, and an improvement in the country's credit outlook. Remittances increased by more than 40% as confidence in the formal banking channels returned. But these gains also came at a cost. Currency devaluation and subsidy reductions placed significant pressure on households as the prices of imported food, fuel, and other basic goods rose sharply. Similarly, whether Kenya's current efforts to fund investments through asset sales, PPPs, and alternative financing structures will achieve the intended purpose remains uncertain. But the intention is clearly there, and the government appears committed to seeing this strategy through. Do you think this is a sustainable path for Kenya, or is the country simply delaying harder questions around debt? Let me know what you think in the comments. If you enjoyed this video, please consider leaving a like and subscribing to the channel so you don't miss the next episode of The Growth Line.